AI investors got rich. Cash investors lost 50%.
Wait, cash investors lost 50% in a HYSA?
Not in dollars. In opportunity cost. $100,000 invested in AI-driven S&P 500 became $181,000 in 3 years. Same $100,000 in HYSA at 4.5% became $114,000. Gap of $67,000. That is 67% worse. Mark Tilbury called this in 2023. Now 2.18 million people watched him. Hidden math opens the case. Chapter 1. Verdict first. The number today is 22% annualized.
Annualized? Compounded?
Yes. S&P 500 returned 22% annualized 2023 through 2025. That is more than triple the historical 7% average. Why? AI companies drive 60% of that return. Nvidia, Microsoft, Google, Meta. AI exposed names. BlackRock data 2025. Investors who exited equities in 2023 over AI bubble fears missed $40,000 per $100,000 invested. That is not a small mistake. That is generational wealth lost. But cash investors had a logic. Let us hear them. Chapter 2. Faction A. AI investors pivoted early.
We are the AI investors. We saw what was happening in 2023. ChatGPT exploded. Nvidia 5x. We rebalanced out of bonds into broad equity ETFs heavy in tech. Specifically VOO, VGT, QQQ. Each AI overweight by structure. $100,000 became $181,000. Tax efficient because index funds rarely sell holdings. Long-term capital gains rate 15% on the gains. Ordinary HYSA interest taxed at 24 to 37%. Even after tax, AI investors net $169,000. Cash investors net $108,000. Gap $61,000. We did not pick stocks. We picked the index that captured the trend. Chapter 3. Faction A. Why ETFs over individual stocks? Mark Tilbury and others recommended individual stocks. Risky. Nvidia returned 700% 2023 to 2025, but you had to know in 2022 to buy. 89% of retail investors who picked individual AI stocks lost money 2023 to 2025. They bought late after the move or sold early in dips. ETFs solved this. VOO holds Nvidia, Microsoft, Google, Meta automatically. As they grew to dominate market cap, the ETF rebalanced. You did not need to pick winners. You owned the index that owned the winners. $100,000 in VOO 2023 became $181,000 with zero stock picking effort. Chapter 4. Faction A. The compounding window. Critical math here. The first 3 years of AI rollout were the asymmetric upside. 2023 to 2025 captured 60% of expected AI productivity gains. 2026 to 2030 will see another 30%, plus broader sectors. But the explosive multipliers are largely gone. Returns will normalize to 12 to 15%. AI investors who entered 2023 captured the explosion. Late entrants get the tail. Compounding penalizes delay. $100,000 not invested for 1 year means $22,000 of opportunity cost. At 22% annual return, that compound takes you well below S&P 500 historical. Time in market beats timing the market. We were in. Chapter 5. Faction B. Cash investors play defense.
Hold on. We are the cash investors. 4.5% HYSA was the highest in 15 years. Free risk-adjusted return. Federal Reserve raised rates in 2022 to 2024 to fight inflation. We rode that wave. $100,000 at 4.5% compounded 3 years became $114,000. No risk, no volatility. Stock market 2022 lost 19%. We did not. Pension funds managing trillions hold significant cash. They are not stupid. What looks slow becomes critical when crisis hits. Chapter 6. Faction B. The bubble fear was rational. AI investing in 2023 looked like 1999 dot-com bubble. Nvidia P/E ratio hit 75x. Historical S&P 500 P/E is 17x. That is 4x overvalued by traditional metrics. Many smart investors said this is bubble. Stay in cash, wait for crash. How Money Works documented 50% of AI data centers were cancelled in late 2025. That suggests AI rollout slower than priced in. Bubble could deflate. If S&P 500 corrects 30%, AI investors lose $54,000. Cash investors lose zero. Risk adjusted, our 4.5% looked smart. Still does. Chapter 7, Faction B, the dollar cost averaging counter. For new investors, lump sum into AI ETFs in 2023 was lottery. Smart move was DCA, $5,000 per quarter, 12 buys over 3 years. That captures average price, not peak price. A $60,000 DCA into VOO 2023 to 2025 would now be worth $94,000. Same as if you held 60% in cash and 40% in S&P 500. Less return than full AI investor, but less downside if AI corrects. We do not advocate 100% cash. We advocate 50% cash, 50% broad index. Sleep at night while still capturing market gains. Chapter 7.5, Faction B, the 2026 reality check. Late 2025 changed things. AI rollout slower than promised. Microsoft scaled back data center plans. Google delayed Gemini deployments. 50% of planned AI infrastructure canceled or delayed. This signals overcapacity. Companies built AI faster than demand. When demand catches up, fine. If not, AI stocks correct 30 to 50%. Cash investors at 4.5% compound through correction. AI investors lose half. We are not anti-AI. We are pro-risk management. 50% cash, 50% index lets you survive both scenarios. Chapter 7.7, Common ground emerges.
Both factions agree on one thing. 100% in either side is wrong. 100% AI investor wins big when AI continues, catastrophic loss if AI corrects. 100% cash investor avoids loss but loses 60% of potential gains. Sweet spot is allocation based on time horizon and risk tolerance. Age 25 with 40-year horizon, 80% equity, 20% cash. Age 50 with 15-year horizon, 60% equity, 40% cash. Age 65 retired, 30% equity, 70% cash and bonds. This is the actual recommendation from financial planning textbooks. AI did not change this rule. AI just amplified the cost of wrong allocation. Chapter 8, Final data comparison. Let me consolidate the numbers. $100,000 invested 2023 to 2026. AI investor, 100% VO. Final value $181,000. Pre-tax gain $81,000. Cash investor, 100% HYSA at 4.5%. Final value $114,000. Pre-tax gain $14,000. Gap, $67,000, or 67% worse for cash. After tax, AI investor net $169,000, 15% LTCG. Cash investor net $108,000, 24% ordinary. Net gap, $61,000. For someone retiring in 10 years, this is one full year of pre-retirement income lost. For Gen Z investing 35 more years, the compounded gap is much larger. $61,000 at age 30 grows to $458,000 at age 65 with 7% compounding. That is the difference between comfortable retirement and lean retirement. But this only worked because AI rallied. If 2023 to 2025 had been a bear market, cash wins. Strategy depends on what comes next. AI continues, AI corrects, or stagnation. Chapter 9, Verdict and Action. Verdict. AI investing 2023 to 2025 was generational wealth opportunity. Cash investing was defensive but expensive. Going forward 2026 to 2030, the asymmetric upside is gone but AI sector still leads earnings growth. Smart middle path, 70% broad index ETF, VO, VTI, 30% cash for opportunity buys on dips. This gives you AI exposure through the index, plus cash for crashes. 3 actions tonight. 1. Open a brokerage account if you do not have one. Schwab, Fidelity, Vanguard. 3. 2. Set automatic monthly investment of $500 to VOO or VTI. Captures DCA over time. 3. Keep 6-month emergency fund in HYSA at 4.5%. Not for investing, for survival. Mark Tilbury said it. Time in market beats timing the market. But you have to be in the market to win. Chapter 10. Closing and call to action. One last thing. Hidden math is not about getting rich quick. It is about not getting poor slow. $67,000 opportunity cost over 3 years compounds to $458,000 over a working life. That is the difference between owning a paid-off house at 65 and renting forever. The hidden math is silent. It does not knock. It just leaves you behind. Mark Tilbury says, time in market beats timing the market. Get in the market. Stay in the market. Never panic. Next episode, why $7 coffee costs $107,000. The hidden compounding math. Are you AI investor or cash investor? Comment your faction.
Aggregate results in next verdict.
Hidden math closes.